Now, AI is taking over or is expected to take over a lot of white collar jobs, which is scarier than what we've been through before, but also what can you do? What can you do to make your own money, to have your own assets? Because guess what's never going to be taken away? Your assets. So if you're looking at real estate, it doesn't matter if AI is helping with property management, if AI is making acquisitions different. If you own an asset, AI is not going to take it away. So you can at least put that aside if you're looking at any sort of asset, even from the business side. It'll change businesses a lot, but businesses are assets. Real estate is notes. There are lots of different assets, and that is not changing. So a lot of times we like to worry about what is changing, but it can help to reframe into what is not changing and approach it that way as well.
Amanda, it's a pleasure to have you here. Thank you so much for making some time to come and be on the show.
Absolutely, Trent. Looking forward to it.
So I've got a bunch of questions, as you know, that I want to ask you. And before I dive into all of that, let's give the audience a quick intro as to who you are. If you could unpack that in a minute or less, that'd be great.
I'm Amanda Cruz, an owner of Voyage Investing from North Carolina. I specialize in manufactured housing, meaning I buy mobile home parks, I add value to them, make them worth more money, and then usually hold them, sometimes sell them. And I also build manufactured homes on their own parcels of land outside of Raleigh. So, really just started in real estate investing in 2018 and quickly specialized in manufactured housing and never looked back.
So that actually dovetails beautifully into my first question for you. So prior to this, if I did my research correctly, you were managing a team of analysts, I think at Capital One. And then in 2017, you decided to make a change. There's a lot of, I think, uncertainty these days for people in the corporate world. They're looking at AI, they're looking at headlines, and they're possibly getting a little uncomfortable with what's going on, and maybe it's going to affect their retirement plans if they're close-ish to retirement. Can you unpack for us a little bit, like, what was it that happened back then that made you decide, okay, this path that I'm on is no longer the most viable path for me and I need to make a change? And as you're answering that, also, if you could address what the audience would undoubtedly feel is fear. Every time we have to make a big change in life, there's fear that, well, what if I screw it up?
100%. Going back, for me, it was more personal. I had a very straightforward thinking on how you make money. My mom retired from a public school system. My dad always had a W-2 job. So that's what I did. I got an undergrad, I got a master's, and I just worked for somebody else and started climbing the ladder. And I loved it. And I was getting promotions and things were going great. But I really started to question where I wanted to be. 2 promotions ahead didn't look very appealing. So I was wondering, what could I do? What would it look like if I made my own money? But I never did anything. Like, a lot of people probably think that for years and then they do nothing about it. And that was me for several years. And then I had my first baby. It was quite a traumatic experience. I survived through it. We both did. We're all good. But then it really made me think, what am I doing here? Am I just going to keep going on the same trajectory I'm not super happy with? And so at that point, after having my first baby and being super busy, I decided then I would start another business. I would look into other things. We ended up buying our first piece of real estate about a year after we had our first child. And it was nothing game changing. And that is going to be the case. Whenever you start something on the side, the first thing is not going to change your world, but it's a stepping stone. And so we bought our first property and we rehabbed it and we got tenants in there. I'm like, okay, this is fine. A little scary. There was some mold or whatever can go wrong for first time investors, but we worked through it. And we just kind of kept doing that over and over. And that was 2018. It's funny, at the time, every real estate seminar you went to was like, this is the top of the market. We are getting ready for a crash. Like, everyone knew it in 2018. Everybody was preparing for a downturn, but we were just continuing safely because we still had our W-2 jobs, as me and my husband, Jonathan. If I look at today, it's very similar. Now, AI is taking over or is expected to take over a lot of white collar jobs, which is scarier than what we've been through before, but also what can you do? What can you do to make your own money, to have your own assets? Because guess what's never going to be taken away? Your
Yeah.
assets. So if you're looking at real estate, it doesn't matter if AI is helping with property management, if AI is making acquisitions different. If you own an asset, AI is not going to take it away. So you can at least put that aside if you're looking at any sort of asset, even from the business side. It'll change businesses a lot, but businesses are assets. Real estate is
Mhm.
notes. There are lots of different assets, and that is not changing. So a lot of times we like to worry about what is changing, but it can help to reframe into what is not changing and approach it that way as well.
So for someone who is in a similar place right now, maybe they have fear that the corporate gravy train, so to speak, the corporate job is going to end, or maybe they know it's going to end and they've got 6 months or 8 months or whatever. They've got a time frame. They've got some runway. Fear is such a powerful force for I think every human. There's probably some exceptions, but I'm not in that camp. What were some of the things that you did, even just things that happen in your head, or maybe you journaled, but I just want to help folks who are facing this transition for the first time to be able to compartmentalize, to be able to think about that fear in such a way that it is not something that stops them in their tracks. Sure, it needs attention, but let's not have it be a brick wall. Let's have it be maybe a speed bump instead.
When I was going through it, the big thing I would hear at the time was, what is the worst thing that could happen? What is the worst possible scenario? And if you have a W-2 job right now and you're trying, you're out there on your own. So the worst case that happens is you lose your job, you have to get a different one. You have to have AI skills. None of that changes whether or not you start living your dream life or you start moving down that path or not. That's not going to change either way. So let's say you make a step in the direction that you want to be in. What's the worst? You fail, you lose the money you put into it, but probably you're not worse off than you are right now. Probably if you think of, maybe I can't go on that trip, or I can't take a vacation, or even something terrible like, oh, I don't have money for my kids' college. If you take a step back, it's really not that bad. Whatever your biggest fears are, aren't as bad as you're perceiving them. Just write them down and then work through it.
Mhm. Yeah, I find that's an exceptionally helpful strategy. What's the worst that can happen? What's the worst that can happen? What's the worst that can happen? And when you see it on paper, it suddenly becomes a whole lot more manageable. So,
100%, because once you see it, you can strategize around it.
yeah, actually, I was just listening on my walk at lunchtime. I was listening to, again, for the second time, Ray Dalio's Principles book, of the Changing New World Order. And one of the things he said at the very end of the book, he's created this storied career as this guy who's studied history and understands trends and cycles probably better than most humans do. But at the end of it all, he says, you still need to expect to be wrong the vast majority of the time. So how then do you move forward? And he says, you have to look at the worst case scenario and you have to figure out, do you have a plan to be able to survive that worst case scenario? And is that something that you can sit with? And I thought that that was incredibly valuable advice, because I've always lived by trying to focus on the things over which I have control. And then the other things that I don't have control over, I mean, you can drive yourself batty over those, but that's not going to do you any good. So after you did the
And
first
honestly,
house, go,
before we even go into that, like, there's a mental game of worst case scenario, but if you haven't prepared yourself financially, you better get in that ball game. Like,
yeah.
you need to have money set aside. Like, if you haven't done that, the mental battle doesn't even make sense. Like, you need to be prepared financially. So that is definitely step one too.
And he mentioned that. And for him, it was building up, how many weeks of expenses do I have? How many months of expenses do I have? How many years of expenses do I have? And when you get to the point where maybe you have a couple of years, because recessions typically don't last too terribly long, that's going to add a whole lot more comfort, I think, for a lot of people. But it's easy to say, but it's not necessarily easy to do. All right. So let's talk about now mobile homes. So I'm a big fan of mobile home parks. I've been investing in them for, I think, 5 or 6 years now. You have had some tremendous success. But I think that for a lot of folks, they probably think of mobile home parks as this, white trailer trash, dirty, dingy place that you might not want to have anything to do with. So, what did you see, if you can put your rearview mirror on, what did you see in that asset class that you think other people, and they've become a lot more popular, to be truthful, but what
Oh,
did you,
yeah.
yeah, like a lot more popular, but what did you see back then that maybe other people weren't seeing?
It's funny you say that people don't want to be in mobile home parks, and I'm in it. And I feel like everybody wants to be in mobile home parks
Yeah.
because it has gotten so incredibly popular. Now, I wish when I was in 20, let's see, 2019, doing our first manufactured homes, that I had assessed all of the different asset classes and really went through a deep dive approach. And I was like, oh, I like that the manufactured home parks are reducing in number, that it's affordable housing, that there's no shortage of demand. There are value add opportunities because a lot of them are owned by mom and pops still to this day who aren't running it like a business. I love it for all those things today.
Mhm.
Back in 2019, when we were doing our first ones, we were annoyed because we were doing a burr, which is just, hey, we bought a stick built, a regular home, nothing to do with manufactured homes. And we were renovating it to do a refinance and hold. That's what everyone was big in doing back in 2018, 2019. And so we were doing those, and managing contractors honestly kind of sucked and we weren't that great at it. So we're 3 months into what should have been a 3 week renovation. Like, gosh, this guy, Bill Cook, who I love, he told me about this thing called Lonnie deals, which is
Yeah.
buying one individual mobile home in somebody else's park. You buy it for a discount like any other real estate, and then you turn around and you sell it and you carry the note, right?
Yep.
They're you have the note. So they're paying you over time and they're going to live there. So we did some of those and they went very, very well. Now, if you're looking for a way to get into real estate, starting with an individual manufactured home is so approachable. If you don't have a lot of money saved up and you want to be on the active side, it's literally a few $1,000s to go and do that. It's very cheap to get in. You're not going to make a whole bunch of money. It's not going to change your life, but just the reps of buying, selling, doing it. And then you're making some money. That's how we did it. And we were like, oh man, there's so much demand here. There must be something more to this asset class. So we really just started learning about parks at that time and started acquiring parks.
All right. So you start, if I did my research correctly, you had people who wanted to start investing with you before you were ready to let them, and then at some point along the way, you changed your mind and you thought, okay, I'm gonna take some investor dollars. When you do that, assuming that you're a human with a good soul, you take on a lot of responsibility because now you're playing with I'm not even going to use the word playing. You're operating with other people's money. And most likely those people
That's
are
right.
in your, friends, family, people that you have a existing long-term important relationship with. So what were you worried about when you started taking money from investors? Or were you? And I assume,
Yeah, so there's a ton of responsibility. So I felt that responsibility very heavily, which is why we didn't do it for several years. We didn't take investor capital for 4 years after we were in real estate. We were only using our own money because we didn't know what we were doing at first. So you have let's think about the lay of the land. We're in mid 2026. There are a heck of a lot of cowboys who started syndications
oh,
in
yeah.
2019, 2020, 2021, and they brought in millions of other people's dollars and lost it, completely lost it. And during that time, if you go back to those years, we were acquiring slowly. We were acquiring stuff where I felt really great about the numbers, and that's how we still acquire. And we're watching all these other investors buying I mean, huge assets, way more, scaling so fast. And
Mhm.
my husband is looking at me like, Amanda, why can't we pay that? Why can't we make these work? I'm like, look, I don't know what they're doing. I don't know, but I know what I feel comfortable with. So we lost a lot of deals. We still do to
Mhm.
this day. But that's going in knowing we know the numbers. We felt good with where it was. The other part of it is we do a ton of private lenders. And so that means they're not coming in with us as part of the syndication. They're not taking a business risk. They're getting a straight return on their money secured by a real estate asset. And that in itself is a ton less risky than syndications because the business plan doesn't have to go well for you to earn your double digit interest rate. So we often pay 10% interest. So even when we were bringing on private lenders to begin with, like, okay, well, what's the worst case scenario? We pay them off, right? Like we'd already had success in real estate before we started bringing on private lenders, and so it's kind of back to the same thing.
Yeah, you were getting near and dear to my heart right there. Investing in debt funds is actually one of my favorite things to do. And it became one of my favorite things to do because I've been investing as an LP for I think 6 years now. I had one loss and it was a big one. And I thought to myself, I don't ever want to be in that situation ever again. But that's a story for another time. All right. So can you walk me through why you think mobile home parks behave differently from multifamily or single family rentals? And specifically from the perspective of one of your passive LP investors?
Yeah, I don't know that they behave that differently. You have tenants, they rent there and they pay you rent to stay. So
Mm-hmm.
diversification in income streams is a similar benefit to both multifamily and mobile home parks, right? You have, let's say, 50 tenants instead of one or two tenants paying rent. So compared to, let's say, a warehouse where you're either 100% occupied or you're
Yep.
100% vacant, in both apartments and mobile home parks, you may have 50 tenants there. So on any given month, you expect maybe there's one vacancy. Who knows what happened to that home? They're changing hands or whatever. It's much more predictable as far as vacancy. It's not a zero or a one. There's also on the benefit to mobile home parks, a ton more demand, right? It's affordable housing. Guess what hasn't been overbuilt in the past couple of years would be mobile home parks. In fact, the number is still declining. So while multifamily had unprecedented building with 0% interest rates, and now new units have flooded the market, rents are down, vacancies up, that's really hurting multifamily investors. Mobile home parks saw nothing like that. Fundamentally, how they were acquired leverage wise was different too between multifamily and mobile home parks over the past, call it decade. You don't see the bridge debt in mobile home parks like you do in multifamily, which, as we all know, bridge debt, that short term 18-month, 2 years, you have to turn around, improve the asset by however many millions of dollars in order to refinance and get your money back, having to do that on that short time frame. That's what collapsed so many multifamily deals. Well, if you don't have that short-term bridge debt, you don't have that ticking time bomb of, oh, my business plan's going, let's say, slower than it it was supposed to, or slower than I thought that it would. Well, okay, then I have extra time. It's not a ticking time bomb of having to refinance. So there are a few differences there, but honestly, the biggest is just demand. That being said, mobile home parks, because it's just kind of gone on the straight and narrow, there haven't been a lot of investors who've lost capital in it. In fact, I know there are investors who are overpaying, especially coming from multifamily into mobile home parks, but I don't know investors who have lost money directly in deals that are with syndicators that I know. Certainly that hasn't happened to our LPs, but it's not as prevalent in the mobile home park space at all.
Have you been looking in my portfolio? All my wins are mobile home parks, and the one stinker that I was telling you about was a multifamily deal bought with bridge debt, and that's exactly why we got creamed.
Oh, Trent,
I
I could have
laugh
told
now,
you
but
that with my
it's
eyes
not
shut
funny.
naturally. Yes. It's not
Yeah.
funny. And it's unfortunately happening to so many people who don't even know it yet. That's actually, I mean, because the can's just been kicked down the road. And I think this is the year where if you don't know it yet, but your distributions are paused, you probably don't have any equity left either.
Oh
It's
no,
all, it's awful.
gone, gone, long gone.
Mhm.
That's again going back to debt funds. Why I like debt funds so much. You're first in the capital stack. So if you're at a 60% LTV, you got 40% of safety above you. That's the equity folks. They'll all get smoked, and you'll still have your money, and you're still getting paid every month.
All right, Trent, I have to ask you that. All right, this is your podcast, so I'm not going to take over because I do the best ever podcast every Wednesday. on commercial real estate, and debt funds is just such a big thing right now. Every syndicator who was syndicating multifamily, they just turned into debt fund syndicators within a 2-year time frame. But here's where I'm concerned. They're all backing either one, rescue capital, or two, flips. All right, so everyone says, I have this great LTV, we're backing all these flippers. Hundreds of millions of new dollars of debt funds have been raised in the past, call it 3 years. Are there that many new flippers? No, there aren't new flippers. So where there's risk here that I don't think it's going to end super well for all of the debt funds that are out there.
Oh, I agree completely. And I don't invest in any of them that do the flipping stuff. Not at all. I think
Okay, what do you like yours backed by?
The one that I'm currently doing due diligence on is Class A real estate in New York. And their LTVs can go no higher than 60 across the portfolio right now. I think it's about 44. So 44% loan to value in Class A real estate in a market where vacancy is essentially non-existent. To me, I feel pretty safe. And this is a fund this is a family office that you've never heard of, I promise you, that has been in business for 40 years and doing this.
Heck yeah.
That's where I get my comfort from. These guys that are out there, making 15 to 20% a year in their debt funds, I think that those are time bombs waiting to go off.
100% they're time bombs because all the syndicators that were doing multifamily and failing at those just decided to raise these debt funds, all backed by the same flippers or the same rescue capital, which is incredibly risky. We never even went that path. Like when we raise debt, we do private lenders on like an individual park that we're buying or an individual build we're doing, never a fund. Because guess what happens with funds? You have to keep that money deployed. In order to get the target interest rate, you have to keep it out there, which means you have to lower your risk, increase your risk tolerance. Yeah, lower the floor that you're willing to deploy the capital to. And I totally agree with you. This is a ticking time bomb. So if your investors or your passive investors or your listeners are considering these debt funds because they are sold as a lot less risky than the equity syndications, I'd be very careful with what's backing it. What's the collateral backing those debt funds?
Yeah, because think about in a housing crash scenario. Let's just look at one flipper. You've got a flipper. He's got some money in the deal. Real estate prices have just crashed, say 25%. He's just going to walk. Now multiply that by every flipper in the fund. Fund says, oh yeah, well, we'll just take them all back. Okay. What happened to interest payments when everybody just walked? That's a problem. And then they got to either have an in-house GC or they got to somehow get the loan performing again by moving it to somebody else. But if housing prices have dropped that much, who's going to want to take it over? And so we could go down a whole rabbit hole on that, and maybe we could do that another time. But I agree with you. Anytime, this is how it was explained to me when I was talking with the family that's been doing this for 40 years. They said, we've been through so many cycles. And the reason that we only are ever trying to make 10 to 12% per year is because we never want a loss. We never
100%
want the goose egg. And I know I used to manage people's money. My first career when I was much younger was a financial advisor. I was one of these guys that worked for Merrill Lynch, and I was a part of a team, and we had $300 million of family money under our care. And with almost no exception, people are far more concerned about losing their money than they are about making outsized returns. Sure, there are people who are wired for outsized returns and they're speculating on stocks and crypto and doing all the things. That's not me. I'm like the Warren Buffett rule number 1 guy, don't lose the money. And that's for me after taking that loss, because I was inexperienced at the time. That was, I think we invested in that like 5 years ago now, 4 or 5 years ago. I was inexperienced. I was an inexperienced LP at the time. And I wasn't as good at due diligence as I am now. I don't ask as many, like if I was doing, you don't want to do due diligence with me. I ask so many questions. It's ridiculous. But
All right,
anyway,
make sure Trent is not on our investor list. Got it.
yeah, yeah, exactly. All right. So let's try and get this back. I appreciate you taking that little turn, by the way, because I think it is an important thing for people to understand.
Yeah, and I have to share one story before we move on because one of my friends was he's always wanting to invest with us or he wants to lend to us.
Hmm.
And every time we have an opportunity, I let him know. But every time he says, "Oh, Amanda, I just you're paying 10% and my floor, the lowest I'll go is 18%." I'm like, dude, hold on. You are also last week you were telling me that you lent money and it was in second position on a subject to property with no equity. Your lender, your borrower ghosted you a year ago. You haven't gotten a hold of her and you are out that money. You are smart. Can you please just run the scenario where you get 10% without losing money and then you run it where you get 18%, but every 10% of your deals go to zero. Run those numbers and see how it goes. He's like, I know. But then the next time again, he's like, oh no, my floor is 18%. I'm like, just please don't be that guy if you're listening and looking to if you want to do 18%, you better have done that asset class. You know what goes wrong. You're willing to take it back over. In fact, you kind of hope they fail because you know exactly
Yeah.
what to do and
Yeah.
that's your business to go make the most money.
Vulture
But if you
lending.
want an actual passive income stream, do not go with 18% because whatever is backing that is so risky that borrower couldn't go anywhere else for a cheaper loan. And that's a big red flag.
Yeah, it's a simple thing that people are paying 13 and 3, which is 13 or 12 and 3, which is hard money rates, 12% annual, 3% origination fee. It's because they literally can't get the money anywhere else.
100%.
All right. So you mentioned on the best ever show at some point that your target minimum was IRR was 15% before you would go forward with a deal. Again, if I did my research correctly, which
I love
you
this.
can correct me if I didn't. But I want you to walk us through what that actually means in a real deal. Not just the number, but like how do you get there? Unpack that as best you can, please.
Yeah, I love that you brought that up because I think honestly, I used to go for 18%. I don't know that I would. I always said that, but I'd pass on deals that were at 18% back in, let's say, 2021, because everyone else's deals were doing that. I was like, oh, we're never going to get anybody to come on board with us if I can't get 18%. And man, do I wish I would have bought those now. But if we're doing a syndication, yeah, I think 15% is very reasonable. I think it was a lot more rigid to be in the higher teens a couple years ago because that was the norm. Funny enough, the people we were competing against ended up losing others' capital and we haven't. So that's a bit of a difference. But how do you get there? So IRR is honestly a little bit silly. It's your return just adjusted for time. So let's say you were going to get a 15% return annually, but the more money you get earlier, it increases the IRR,
Yeah.
which sounds great, except it can get skewed when you have, let's say, really low returns out of the gate and it's all dependent on this gigantic return of capital plus upside 5 years down the road, which means that anybody who's projecting that has also projected what the interest rates will be in 5 years and projected what the market will be and projected
Yeah.
what cap rates will be, and it's impossible. So it's a little silly, but that's what the syndication world uses. But really, it's just, hey, it's a combo of all these things. What is my cash flow in year one, in year two, in year three? What is my actual cash flow during the life of the project? And then the entire reason you do an equity syndication is to participate in the upside that should be there through a successful business plan execution. So if you combine that upside with your cash flow during the life of the syndication, that's how you come up with the IRR. That's how you come up with the return.
Okay. So you shared publicly that you mentioned walking away. So you shared publicly, again, if I did my research right, that you walked away from a deal that you were under contract on because the returns didn't pencil once you were given all the data. And so I think there's this principle called invested time. The more time we put into stuff, the more we want to get something back out of it. So it's a really hard thing to like walk away from a deal when you've got 20, 30, 40, 50 hours of due diligence into it. So how did you make that call? And what did that moment reveal for you about how you think about your investors' money?
We've done that several times, but ultimately you go in with certain assumptions about a property, and then you do a heck of a lot of due diligence, just like you do. If you're an LP and you're going into a syndication, you do a lot of due diligence. Well, as operators, that is our role, to do a ton of due diligence on the property. And things come up like, oh, well, we thought there were 30 homes. It turns out only 26 homes are paying, and the others are in such bad shape, they're not going to collect lot rent. Things change. What is the infrastructure? Like, maybe we thought there were PVC lines, but it's actually a much worse infrastructure that might cost $50,000 to repair, and the seller's not willing to work with us. Things like that come up all the time. My favorite park that we own, we walked away from, and we just couldn't get there with the seller. And he felt like, we were trying to go back and forth and negotiate what could work. And he was like, he felt, I think, overwhelmed by the end of due diligence and having to make a decision. So we walked, because he wasn't willing to come to what we needed. And then 2 months went by, and we reached back out. We're like, hey, we are really interested in this property. We couldn't make it work before, but we do really want to buy it. We just couldn't buy it at what we were talking about. And we ended up making it work, and he ended up understanding, and we worked something out with him where he carried some seller financing, and we ended up buying it. It's my favorite park that I own. And that was a heartbreaker, because it was in a good market. It was a decent sized park. I think there were like 43 lots there. It was a good asset to own. And we were like, at the end of our due diligence period, we probably had most of our investors identified, and we had to walk. And it ended up working itself out in that case. There have been others where it hasn't, but it's better. I mean, Trent, if you're disciplined, then it's better to walk and, oh, sorry guys, this isn't going to be an opportunity,
Yeah.
versus buying something in your gut isn't right.
Yeah. Rule number one, don't lose the money. Because when you lose the money as the GP or the capital aggregator, you destroy your reputation, and then you're just killing your career, essentially. Have you, a sidebar question about parks, have you ever been in a deal where you looked and there was a bunch of vacant lots and you thought, oh man, if we could fill all those, the numbers are going to go through the roof. But then when you actually do the due diligence, you realize those are not legally saleable lots? Or not, sorry,
It's not
saleable.
even that, Trent.
You can't fill them in because there's either the city has changed their zoning or something's gone on, and you're like, those things are going to be empty forever.
Oh, that happens all the time. Zoning is like the first call. Before we spend any money, we're talking to the planning department.
Yeah.
As soon as we go under contract, sometimes even before. It depends on how quickly we go from conversation to going under contract. But yeah, planning department is number one. There are so many of these. Another big red flag to watch out for, if you are an LP investor looking to come into a mobile home park deal, or even a private lender looking to lend with a mobile home park as the collateral, infilling vacancy. A lot of these multifamily guys have been flipping over to mobile home parks, and their underwriting of how quickly they can infill vacant lots is amazing.
Yeah,
I
I have no
mean,
idea.
they can do it better than I can, and I've been doing this for years now, right?
Yeah.
It's quite amazing. And that's where a lot of them are getting caught up, is that they can see the opportunity to make the park worth a lot of money. But I know this is going to come as a surprise, Trent, but when you buy a half vacant park in a market where there's a declining population, it's actually really challenging to infill that community. And so your projections, don't go to plan. And this has happened. In fact, we had a guy buy a park from us last year. We got just a super good deal, but we didn't want the park because we don't like the market. But we got it for like just a really good price. Like, fine, we'll buy it and we'll just list it for sale. And that's what we did. And this multifamily operator came in and he bought it. He was really excited about infill. And then I was talking to him last week. He said, well, it's going slower than I expected. Like, okay, but you have your first home in, so that's pretty quick. You've only owned the park for a few months. He was like, well, it hasn't sold. I was like, well, okay, what were your expectations for how many homes you could infill in the first year? And he said, 3 to 6. His first year, his first mobile home park, no connections, no anything. He thinks he's going to come in and infill 3 to 6 lots in a 20 lot park. And he's on number one and it hasn't sold 6 months in. So
Yeah.
I'll tell you everything you need to know about how that business plan's going to go.
So for the LPs who are considering looking at a mobile home park, my advice to you is to ask the GP for a copy of the letter from the city planner that says, yes, you can go ahead and infill those lots.
And it's not just the infill too, because infill is such a complicated thing. You have to have systems. So you need to know there's zoning, the zoning is allowed or it's grandfathered in, and how many lots are there. But even then you can get tripped up because some of these older lots are tiny and you cannot practically infill them because the new homes are gigantic and they won't fit with the setbacks. So
Yeah.
if you're going with somebody with an infill plan, honestly, the best thing you can do is go with somebody who's done a good amount of infill and knows the process. Because if you go with somebody who's doing infill for the first time, it's going to be a lot rockier. If I would actually not passively invest with somebody who's not successfully executed a good amount of infill. And that's the crux of the business plan.
Yeah, I think that's a pretty solid piece of advice. So I think my next question is actually going to reference that park that you talked about that you bought and flipped to this guy. So I think that if I did my research correctly, there was a park in South Carolina that you bought for 190 and then you flipped it for 735. Is that right? Is that the deal you were just talking about, or is that a different deal?
Oh, no, no, no. We only made like 120K on the park we flipped last year. What we actually executed this one. We bought it. It was in Columbia, South Carolina. So, you know, a good market, better on paper than it actually ended up being in person, but still a solid market in, the capital of South Carolina. Yeah, I mean, we bought it just from somebody who needed to sell, but we executed on that. We held it for 2 years and then we sold it last year for 735.
Okay, so that cues up my question. How do you think about when you get to the point where you've stabilized a park where there's either a refi opportunity or there's an exit opportunity? And from and you've got LP money in the deal. So it's not just your money you're thinking about these other people. How do you navigate your way through that decision?
On this one, we had private lenders. So we didn't have LPs and they
Okay.
were on a 5-year hold. A lot of times when we bring in private lenders on a mobile home park, it's for 5 years because it is going to be a longer term. Like if you're just looking to kind of hold money on the side and make some money in the near term, that's not the right path. But if you actually want just passive cash flow, checks in the mail, well, auto deposits to your bank account, then the
Yeah.
longer holds are good. So that's what we had in this scenario. We were 2 years in, and we bought it right. We infilled some homes, we brought rents up, we fixed up the place, and we were in a spot where we could have either held on to it. And now keep in mind, when we bring on private lenders, they're getting 10% returns and we're basically putting all of our money back into the park. So when we bring on private lenders, we're not making anything especially during the first year, 2 years. And so that's the trade-off of bringing in private lenders, right? Is we take the risk on the upside, bet on ourselves, and our private lenders get a set amount of money, but they don't participate in the upside, which for this park ended up being a lot. And so our decision was, hey, we can obviously refinance out and we can hold, but this was a 20-lot park in South Carolina. It was our only park in South Carolina. We didn't love the market as much as we thought we would. It was definitely, it's a red state, but the specific county we were in was insanely tenant friendly, which made a lot of things just complicated for infilling and raising rents and stuff like that. For evictions, that was definitely more complicated in this county. And so we're like, hey, why don't we take the win and we'll buy more assets in the states that we are already in and grow our portfolios in those markets. And that's what we ultimately decided to do. If you're talking about like what to do when you have LPs, we have that situation right now with my favorite park in Tennessee where we have LPs in. And we're 2.5 years in, and we're ahead of projections substantially, and things are going very well. And it's a matter of, hey, do we take the win now, or do we wait, let them keep? So here's the trick when you're a GP, because it's only been 2.5 years, we could sell now and they would get an insanely high IRR.
Yep.
That's a little bit of a vanity metric, because if you get a super insane IRR, but it's only for a 2-year hold, you still have to turn around and redeploy that capital.
Yeah.
And so, yeah, that's why IRR is a little tricky, right? It's kind of a vanity metric when it's only been a 2-year period. But we are looking at later this year, right around the 3-year mark, going ahead and doing an exit. And, it'll still be a really great IRR. Why not? Why is the IRR not going to be as high at 3 years as it would be at two? Because that same upside is spread now
Spread
over
over
3
longer
years
periods.
instead of
Yeah.
2 years. Yeah. And so, but the actual capital return to them will increase because they're still getting a great cash on cash return during that hold. And honestly, I think mobile home parks are going to continue to increase in value. But at the same time, our business plan has mostly been executed. The other stuff remaining is going to be not as heavy of value add
Yeah.
and take longer. And so from the LP perspective, it makes sense to go ahead and take the chips off the table and take the big win and move on to something else. So that's what we'll end up doing in that case.
Okay. So my audience is made up of folks who are successful business owners, near-ish to retirement, successful executives or professionals. All of these folks, they have plenty of equity or capital. What they don't have is a bunch of time, and they don't necessarily have operator experience. So let's assume that some of them are thinking, hey, this investing in mobile home parks as an LP, yeah, maybe I might like to do that. What are the top 3 questions that they should ask a GP before they would ever write a check?
You want to ask how their current deals are going. And this is especially important because if you're looking at syndicators in 2026, their websites may show amazing track records and they just haven't put the current deal on there, or they're about to be taken back by a bank, especially if it's a multifamily syndicator
Yeah.
who's maybe raising money for something else. Like, you want to know how their current deals are doing, how many capital calls they've had, paused distributions. That's incredibly important. Unlike you, I don't know that that's 100% deal breaker, because so many multifamily people have um, lost. To me, if you did, it's how did you communicate it? How was it proactive? Like, what were the next steps? Versus just like a blanket, none of them can ever raise capital again.
Yeah. Sorry, let me interrupt you if I may. You're steering this towards multifamily. I was asking from a mobile home perspective because that's what we've been talking more about. So I don't know if that changes your answer
Same.
at all.
No, it doesn't, because some operators who've come into the space, well, I think it's more broad, right? Anybody you're going to potentially give money to as an LP, ask about their current deals and their track record. But it was a long time, like, hey, make sure everyone's on 5 exits and all these check marks. But you really want to know about the deals that are currently going on, because even in the mobile home park world, it's not all rainbows and butterflies.
Yeah.
I would look at the rents that they're projecting to be, like, what are the market rents? And it's very easy to go see what they should be. If you just look up like HUD, Housing and Urban Development, they report out fair market rents in the area. And you want to be about half of a studio or a third of a 3-bedroom apartment rent, or the fair market rent in the area. If the rents that they are saying they're going to get are not in line with that, that's a big red flag,
Yeah.
because that's what that drives everything.
And you're talking
And the
lot rent, right?
third, lot rent,
Yeah.
100%. Yeah. And then the third would be, it's all about the market with mobile home parks. It's, if you buy right, it's hard to go wrong, but also buying in a market where the population is declining, honestly, I just wouldn't do that. Don't even ask about it. Just do your own research. If the population is declining, don't invest in that. But then what is the business plan? Is it selling off the park-owned homes? Is it bringing in infill? And what has been their specific experience with those business plan objectives?
So I want to ask you about a tool that people can use to get answers to some of those questions. Have you ever tried Fundrise's new Real.ai tool?
No, I haven't.
God, it's phenomenal. So Fundrise, we have been an LP investor with them at various times throughout the last 6 or so years, and they've done a lot of build to rent. They've got a diversified pool of assets, but they built this tool for themselves. I was listening to an interview with Ben, the CEO of the company, and how they built it, and I've tried it, and it is, if you haven't tried it yet, it's way better than an LL than your ChatGPT, Claude, whatever, for analysis of residential real estate and markets, because they have coded it in such a way that there's a lot of proprietary data that's in there that LLMs might not have access to. And it's, if you want to know, like, for fun, just ask it to give you an evaluation of one of the markets that you're in, and it'll talk about economy, rent growth, job creation, blah, blah, blah. It's pretty darn interesting.
That's
Uh,
funny. I created my own custom GPT to do that exactly, like, I don't know, like 6 or 8 months ago, because we look at the exact same things all the time. I
yeah.
will say the market with mobile home parks, you don't have to be in a primary market, right? You don't have to be in Charlotte, North Carolina for it to be a business success. That's absolutely not the case. You just have to make sure that it's not a crappy market and you're not overpaying for what you're getting.
So, how do you think about the difference between someone who should invest in mobile home parks directly as an operator, like you've done, versus someone who should invest in a fund where they're an LP and there's an operator doing all the work?
Depends on if you want to be active, because mobile home parks are incredibly active, right? If you want to be an operator and maybe you don't want to have a W-2 job anymore and you have time, or maybe you have a W-2 job but you have a lot of free time and you want to take 100% of the risk, bet on yourself, 100% of the upside, and make all of the decisions, absolutely, you should go find a park. It's challenging to find the right ones these days because it is a very competitive asset class. But let's say you find the right one, go ahead out there and take the challenge and do it. I think it's just like passively investing in anything else. Who is it for?
Mm.
For somebody who has the money but doesn't want to spend the time operating it or finding the right one or dealing with phone calls on a daily basis, and they're okay relinquishing control of the asset in order to achieve the passive income and splitting the upside. Because obviously, if you're coming in as a partner, then all of the upside, all the cash flow is split between LPs and GPs versus just yourself if you're the active operator. So if you're willing to take those trade offs, basically buying your time through
Yeah.
somebody else who is the active operator, then that's the right passive path.
Yeah, and I would add to that, and I'm sure anyone who's a high earning professional is already thinking this, but what's the value of your time? If you're a surgeon, the value of your time per hour is pretty high. Is it really worth it to go outside your sphere of expertise and learn something new and divert time that you could be in the operating room, bringing them quite a bit more money? So let's talk about things that can go wrong. And I'm sure you have, because you've been doing this for a while. You must have some great stories of things that have gone wrong. So I'll just leave
Of
that to
course.
you to pick whatever stories you would like. But let's talk about when some stuff didn't go according to plan and then how you worked it out.
There are so many, Trent. Let's say my favorite park we bought. 2 days after we bought it, we got a phone call saying, "I hate to tell you this, but one of the homes in your park is currently on fire, and it's burning down, and fire department's there." So that one was a goner. So that's really fun. 2 days after you acquire an asset, that wasn't on our projections that we didn't we didn't
Well,
want that home
that's
to
what
burn up.
reserves are for.
Um, yeah, and funny enough, not only did the home burn down, but the tenant who we were going to kick out anyways because we knew he wasn't a great tenant, refused to leave the burned down home and moved himself into the on-site shed, and therefore expanding, prolonging his departure from the park by several weeks and lots of visits by police officers. So, that can happen. We actually have had 2 homes burned down in that same park. Yeah, it's reserves, and it's knowing how to infill. It's being a licensed retailer so you can infill and get homes for less expensive and get the lot cleaned up and get it in and sold and be able to execute on that plan. In that case, it's
Mhm.
it's knowing exactly how to infill. And the funny thing about info, I should say more broadly, is even if that's not your business plan, you just have to infill sometimes to keep your park at capacity because things do go wrong. A home might burn down, or somebody might rarely move the home out of the park. So you do have to know how to do that as part of just being in this business. I'll tell you the worst thing that ever happened to us was buying a park in a bad market, and we were getting it for so cheap that we're like, okay, the seller doesn't want us to walk the homes, but we're getting the homes for free. So fine, okay, we're getting this for so cheap. And let me tell you, there are slumlord parks. We buy from slumlords. Everybody who's been in real estate for any amount of time is not shocked by slumlords. This was shocking. I mean, the level of these homes, we had to tear 3 of them down right in the first 6 months because they were so bad they couldn't be brought back. There it was. We also learned that the same seller, had been trading rent for favors from some of the residents in the park, so they weren't all used to paying rent with actual money. And so that had to be a learning lesson. We ended up having to replace almost every resident in that park. I think only 5 of the 20 have stayed, and the other 15 had to be replaced. So just that one was honestly just like blood, sweat, tears, and grit of like, well, here we go. Like, new lessons learned. Let's go.
How long did that one take to stabilize versus your projections?
Oh gosh. So we thought we would have more homes than were originally there, within a year.
Yeah.
Like, okay, we have 20, maybe there were 17 there, and we thought we would like 18, 19, like one a year, kind of on an upward trajectory, but stabilizing the others. And we ended up having to take out 3 right away. And we brought in 2, but like it was a constant. We renovated 1, and then somebody moved that one out of the park. Like right after it got renovated, it was just about to be
They
sold. Like,
moved it
this is
out?
why they moved it out of the park, because we did not approve the person that they wanted to buy it. They had a bunch of evictions, so we didn't approve them. And they're like mad at the people who renovated it, were mad at us and said, you know what, we're going to move it right on out of your park, this nice looking home that just got renovated.
Oh,
Because
wow.
we didn't own the home, somebody else did. I mean, these things can happen. And all of those things that I just said about the park owned homes and the bad conditions and having to tear them down, that's in a market where the population was declining, the only one
Yeah.
we've ever owned there. And it's harder. All the business plan is harder because it's in that market. Now, again, that was the first one we ever brought private lenders in on. So they've been making their 10% the whole time. We just listed that park for sale. So they got completely insulated from
Yeah.
all of the disaster that was that park, other than, their monthly updates of what's going on. But they've gotten their 10% return on a monthly basis for the past 3 years or
If
4 years, I guess now.
if that had been your first park, do you think you would have kept going with parks?
Good question. Maybe not. That one sucked. It still sucks. I mean, it's stabilized now, but it's just harder. Maybe not, Trent. Maybe we would have left the market. You're right.
Yeah. Yeah. There's something to be said for being a little bit lucky at the beginning is not a bad thing. Yeah. And
I'm
yet,
That being said, I'm super thankful for that park, because you don't learn as many lessons when things go well
yeah.
as you do when your entire business plan is upended and you're like, holy crap. And we bought it for really cheap. So like it's it's not a losing scenario, but it's way more challenging than we ever thought it would be.
Yeah. No doubt. All right. So let's finish off with this one. What do you think? I mean, you've got a lot of experience. You've had some war stories. You've had some scars, all what I call tuition moments. What do you think the most important thing that a passive investor who's not invested in this asset class before, what do you think that they need to understand that nobody's telling them?
Trent, that's a good question. I feel like people know so much about this asset class right now.
No,
To
you
be
and me know so much about
so
this asset class, but lots of people don't.
You're right. So let's say you want to get into potentially passively investing in mobile home parks. Honestly, I would just do your your due diligence on the operator and how much experience they have in that asset class because of all the things we just talked about. A home burns down, somebody moves a home out of the park, the zoning, flood zones, insurance, like all the different pieces that you're never going to research your way into being an expert in, and you don't need to be an expert in. But what matters the most is the experience that the operator has and what are the bad scenarios and what happened and what was the outcome for the investors and all of the various pieces because there are so many nuances to this asset class that you would not believe until you are in it and you as an LP are shielded from. But the operator needs to have a lot of experience in the asset class. So I would do most of my research on that.
Agree completely. And then I'm going to add my 2 cents on this because I'm such a big fan of the power of some of today's AI tools. Something I did as an experiment the other day, because I've been doing this due diligence now. I'm probably 50, 60 hours deep on this family office. I took some of their docs. I took 3 of them. I forget which 3 it was. I think it was the operating agreement and the OM and maybe the PPM. Anyway, I loaded them into Notebook LLM. And then I just had it create a podcast about those documents.
Mm-hmm.
And I listened to it. So it has the podcast is co-hosted by a man and a woman who sound completely human. And they literally just had this super interesting discussion about all of the things that are in these documents. And these documents can be really boring to read because there's so much legalese that's in them to the point where I think a lot of people honestly don't read them. I think that they get overwhelmed. But if you've never tried that before, Notebook LLM is a free tool. You upload the documents and then you click the little button that says make an audio summary. And you can make flashcards or there's lots of other things you can do. But I just did this as a fun and games experiment. And I had read the docs and I had been doing a ton. So when I listened to this, I knew it's like, oh yeah, it caught that and it caught that and that. And it talked about that. And anyway, it was a pretty fascinating experiment.
If you add on like, hey, tell me about this and also what are the red flags or things that aren't standard that I should be looking out for, it also knows those, which is crazy, but it also knows that stuff too.
It does. And that's and going back to the question I asked you a minute ago, you could literally just go to your AI of choice and say, I'm thinking of investing in a mobile home park as an LP. I've never done it before. What are the things that I should ask the GP? And you're going to get a list of really, really good stuff. Well, this has been fun. I hope you enjoyed being here. Thank you very much on behalf of the audience for spending this time with us. For the folks who might like to get in touch with you, can you just give us one way? Maybe it's your LinkedIn or your email or whatever it is. You don't have to rattle them all off. Maybe it's your website, but just one way that they can reach out and get in touch with you.
Yeah, voyageinvesting.com. That's our website. You can sign up for our newsletter, which is also how anybody is notified about opportunities we have going forward.
Wonderful. All right. Well, thank you very much for your time, Amanda. It's been a pleasure to have you here, and I look forward to talking to you again at some point.
Awesome, Trent. Thanks for having me. Great chatting with you.